rates. And that would have direct implications on the mortgage industry. But I know that many of you have been crazy busy, during the pandemic. We've seen a rather, amazing development in that property values in Connecticut have gone up. They've gone up substantially, and hopefully, I've heard that characterized as being a correction rather than a bubble in Connecticut. In other areas, it may be a bubble, but hopefully it's a correction because our property values have been stagnant for so long. So that's been good for the industry, both in terms of originations. There's been a lot, record origination activity. I think there'll be, for those of you involved in home equity lines and loans, I think this also is beneficial because there's going to be more equity to, for those folks who do want to do that type of financing. And also on the backside, to the extent that the foreclosure moratoria and that type of thing goes away, hopefully there'll be more, since there hopefully is more equity in the property, there'll be more alternatives to strict foreclosure. So the other thing we see, which is rather amazing to me anyhow, is continuing consolidation in the financial services area. I looked at the one of the tallest buildings in Connecticut was or is the Goodwin Square building on Asylum Street in Hartford. And a few years back, they proudly put up the name United Bank because United Bank was going to be the first bank of any size headquartered in Hartford for decades. United Bank then got taken over by People's United Bank. So another sign went up. People's United Bank has now been acquired by M&T Bank. So the beat goes on. Liberty acquired Simsbury, Webster is merging with Sterling. So again, we're in this area where we have consolidation in the industry. I think that while that poses challenges for some, opportunities for other, certainly the amount of loan originations being made by non-bank mortgage lenders certainly has advanced far more than those by banks, which were originally the traditional source of mortgage lending. So, and the other thing is that, part of this is driven by this, there's too big to fail, but there's too small to comply, and also too conventional to survive. I mean, we have things like blockchain, e-closings. As I was mentioning to some of the panelists before the session formally began, I was in a supermarket the other day. Somebody paid by check, and the cashier took a picture of the check and gave the check back to the customer. Never saw anything like that, but I asked the cashier afterwards. I said, "How many checks do you see? Don't people normally pay by card or other device, electronic device?" And he said, "That was the first check I'd seen, but I knew the protocol." So, in any event, from a regulatory climate standpoint, there has been some easing, I think, in terms of regulation by enforcement and hyper regulation that some would argue it had occurred in prior years. Well, excuse me, there was a rollback from hyper regulation during the last administration in Washington. So will that rollback sort of reverse itself? Other thing is there's, I think, going to be continuing collaboration among the regulators. That goes hand in hand with mortgage industry consolidation, national lending platforms. And I know that, in my conversations with Rich and others at the Department of Banking, certainly collaboration with other state regulators and with federal regulators is something, that they're pursuing. I guess another issue in the background, and I don't think we can get to it today, but the continuing uncertainty about private versus public funding, what's going to happen to the GSEs. I think the GSEs are going to be around for a while. That's the last thing I've heard. I think that's a good thing for liquidity in the mortgage market. And the other thing that I think is going to be an advancing trend is equity and fair lending. And there were a number of bills, some of which Fritz will mention, to try to deal with fair lending issues and affordable housing. Because there is again, the inequity in housing situation sort of is considered a major factor in contributing to the wealth gap between certain underserved and protected classes. So again, in Connecticut, we've been blessed, I think, over the pandemic had a little bit of a silver lining for us, because in 2019, we were talking about the out-migration of businesses and individuals from Connecticut. And, the last person shut off the lights. That has reversed itself. I think that's been a really good thing. I know I've lived in Connecticut for, close to 50 years, and Connecticut's main claim to fame is it's close to Boston, it's close to New York, but it's not as busy or as heavily taxed as either one of them. And so I think that, that sort of attractive feature of Connecticut has come into play and hopefully will continue. So there are a number of ongoing concerns that we'll be seeing. I think those of you who participated in the legislative committee meetings, we always talk about crumbling foundations, the budget, blight, RPay, super liens, foreclosure issues, technological innovation and disruption, and as well as some licensing issues. So I think that, not to mention home invasion, redlining, and work from home. So there's a lot of things that have been coming up, that we've been dealing with, that we'll probably be dealing with for the foreseeable future. But that's sort of my high-level background. And at this point, I'd like to turn the program over to our lobbyist, Fritz Conway of Gaffney Bennett, who once again, I think has done an outstanding job. As you can see from the materials that Fritz will be sharing, many of the bills will be discussed. Some of the bills we'll be discussing passed, but there were many more bills of concern to the industry that were not passed. And thanks, Fritz, for your help in making that a reality. Fritz, you're on mute.
I knew I was going to do that. Thanks, Norm. Appreciate that introduction. And good morning, everyone. Thanks for getting on. Just a couple comments before I get into my presentation. My presentation will be posted by Denise on the CMBA website. And we also have a more complete, if you will, legislative summary. So some of the bills that I will not talk about today can be found in that report, and that is also posted. So I would encourage you to go and check those out. There are bill numbers, public act numbers, and links to analysis and descriptions there. So it's a useful site, I think. Today, I'm going to talk a little bit about the past session in more of a general sense. And then I will get into legislation that was specific to the industry that passed, some stuff that didn't pass that Norm said, and then some general legislation. And I would say that this year there were quite a few bills that folks within your organization who are dealing with operations or human resources would be interested in. And then I'll talk a little bit about our budget and taxes, and then the upcoming 2022 session. So Denise, if you want to look for the next page. So like everything COVID, our session, this past session was a virtual session, which meant that lobbyists could not come into the building, nor could the public. Legislators could vote from their offices. Public hearings were conducted virtually. It was really remarkable, I think, that the legislature and the folks who are the staff the Capitol pulled it off the way they did. There's a lot that goes on behind the scenes with a legislative session, and there's a ton of work that gets done by staff. And I don't think a lot of people know, when we say it was a virtual session, the staff was segregated into groups who came in every day, every other day. So it was never a full complement of staff. Very hard to craft legislation when you don't have people sitting across from you in person. But they did a really good job at pulling it off, I have to say. From my perspective as a lobbyist, it was hard. Everything took longer. It's hard to sort of imagine it, but if you're standing in the hallway in the Capitol and you have 5 or 6 things you need to talk about, and you can't talk about 2, 3, 4, 5, or 6 until you talk about one, when you're not in the room and talking to somebody live where you can sort of have that flowing conversation, you're relegated to texting people, emailing people, and waiting for their response. So it really added a lot of time and a lot of difficulty, but I think we were able to manage that as best we could. And I would lastly say that one of the things that I think a number of things will be positive about the virtual session, but one is the public hearings that were allowed. They were all broadcast on YouTube. They were all virtual, and I think it will give the public and industry a better opportunity to testify, because you don't have to come and sit at the Capitol for hours on end waiting for your turn. You can pretty much figure out when you're going to get called, and you can be in your office, you could be at home, you could be in your car. So I think that will be one of the benefits that will come out of this, and there will be others as well. So Denise, if you want to just turn the page. So I'm going to just start with some industry-specific legislation. And again, it's a virtual meeting today, so I figured I would spare you from endless iterations of lots and lots of bills. So I really tried to pare this down into what I thought were a lot of the more significant pieces of legislation. But if you have questions now or after the presentation or at any time about something I haven't discussed, please let me know. The first bill I want to talk about is Senate Bill 1202. Which was a bill that made some minor changes to the Crumbling Foundation's low interest loan program, and in particular as it relates to condominium associations. So when they first put in the low interest loan program for Crumbling Foundation's folks, it did not consider condominiums. Legislation the previous year did do that, but it failed to really allow for the some recovery of closing costs for condominium stuff, and those are commercial costs, which are, as you folks know better than I, are a lot more expensive than a residential. So it allowed for some level of recovery on that, and it also allowed for banks that are not, or lenders that are not domiciled in Connecticut, to participate in the program. So that was I think a good change to that program. We want to go to the next page. This next piece of legislation, 6516, was passed very early in the session. Was really part of I think the legislature's response to COVID and all things economic that were occurring to people who were impacted by the pandemic. And in particular, what it did was it made clear that folks who had been in a nursing home, et cetera, or may have accumulated some benefit from the state, and that was translated into a cost to the state, those liens could no longer be activated by the state. So if you were in a nursing home and you passed away, and your your costs and what you were leaving for your kids might be impacted by that. That's not going to happen any longer in a lot of cases. So big change, I thought, and one that was necessary. Next page. So this is kind of a similar bill, 941. For years, we have been, and a lot of the industry's folks have been working on the fact that a lot of municipalities will accumulate sewer and tax liens, foreclose, and they will add up to 18% interest on those issues, and then they will sell those tax liens to another third party who may sit on them even longer, and then ultimately collect on those. And it's pretty good business to be in, because it's a priority lien. You're at the top of the line, and you're always going to get paid something. So there's never been the will in the legislature to change the 18% interest cap, but finally we did get some guardrails, belts and suspenders put around how this stuff works. It's not perfect. 18% is way too high, but it is, I think, a positive change. You should take a look at it. The 18%, it raises a lot of money for some of the big cities, so that makes it a difficult thing to overcome. We want to move to the next page. This bill did a lot of stuff. It dealt with the foreclosure mediation program, which is now called the Ezekiel Santiago foreclosure mediation program. It really did four major things. One, as the bill was originally drafted, the program was going to become permanent. It had been scheduled to sunset in 2023, and there was a pretty strong desire among a lot of folks in the legislature to just stop increasing the sunsets and just make the program permanent. At the end of the day, we were successful in getting an extension in the sunset of 6 years. So it's with us for another 6 years, and we'll see where it goes from there. I will say, just on my own personal opinion, it seems to me like the program is working better. It's folks have been dealing with it and working on it for a long time, and I think it's going to be with us for longer than 6 years. Let me put it that way. Another provision that was in the bill when it first came out, and we were able to have it stricken from the bill, was that you would anyone who was in the mediation program would have had to provided similar loss mitigation efforts that had been provided, and I don't think they still are, but during the COVID crisis, forbearance, et cetera, were allowed for any federally backed mortgage, Fannie, Freddie, the VA, et cetera. And this would have applied to all loans, and we were able to get that piece stricken. A third piece, which may be problematic to some folks, requires disclosure of certain loss mitigation efforts that were made by the lender and the borrower throughout the process of foreclosure. Currently, there are certain things in pre-mediation that are made public. Under this piece of legislation, the post-resolution information would also be made public. So it's a change. Folks should take a look at that. I had heard some concern with that, but we were unable to we fixed it to some degree, but not get it completely taken out. And then lastly, the bill allows for, as long as all parties agree and the mediator agrees, the sessions can be done virtually, which I think is a good improvement. Next page. This one, it's very simple in what it did. It really changed the homestead exemption. from $75,000 to $250,000. Big jump. Homestead exemption protects a certain level of a person's property from judgment, and a number of states in the Northeast have done this, including Massachusetts, I'm sure of, maybe Rhode Island. And so it is now 250,000. I didn't put it in here, but it also changed the level on our automobile as well. Next one. For those who are in the commercial side of the business, this was a very simple, straightforward piece of legislation that basically exempted commercial loan originators from the overtime provisions. A number of years ago, we were able to pass an exemption for residential, and this was just a follow-up on that. I would go to the next one, Denise. So bills that did not pass. This could be a very, very, very long list. You'd be amazed at how many really crummy bills get introduced affecting our industry. But I tried to really just highlight a handful that I think will be instructive. And the ones that are on this page, I would say were very concerning in terms of what they would have done to us, but also concerning in terms of how much momentum they had for a while, or in some cases continue to have. And that would be a good lead into Senate Bill 893, an act concerning privacy. This is a bill that would have affected all industry, but it certainly would affect our industry. And that's why I put it in as an industry bill. There's only a couple of states in the country that have adopted really comprehensive privacy laws, California being one of them, and it's turned out to be an incredible mess, if you will. Very hard to comply with, very expensive to comply with. Lots of changes that have been considered or enacted by the state since then. A lot of other states are grappling with this. Connecticut is one of them, and it is not going to go away. I would suspect that this legislation in Connecticut will pass. Some sort of legislation will pass in the next couple of years, maybe even this coming session. But for us, we were really looking for a Gramm-Leach-Bliley Act exemption, which some states have done. California did not. The other state that passed it did. And we were really got into a debate with the Attorney General, legislators, and others about whether or not the GLBA exemption should only apply to data that would specifically fall under the GLBA definitions, and then any other data would be subject to the privacy issue. So if you went online and you were really looking up mortgage rates and terms, et cetera, you would be covered by the exemption. But if you went online and you were looking for a rewards program or something that may fall outside of what GLBA is supposed to cover, you would have to have a privacy program in place for that. We did not succeed in convincing the Attorney General to do that, but we did have folks who were willing to put that in the legislation. But as I said, ultimately it failed. But this is coming back, and it's going to be something that folks will definitely have to comply with, and it will be a challenge in one way, shape, or form, I'm sure. 5090, crumbling foundations, as you all know, Connecticut has a large population of folks who were impacted by this, and as a result, we see crumbling foundation legislation all the time. This piece of legislation would have required that you provide mortgage forbearance to someone with a crumbling foundation. We were ultimately able to defeat that, but expect to see it back again. 6593. We've grappled with this for 2 years in a row, and I'm hopeful that we won't have to grapple with it again, but I suspect we will. This was a bill that on its face, a lot of folks thought in the legislature, wow, that's a good idea. Basically what it does is it says that in order for a property maintenance organization or a lender to protect the property and go into the property that's in foreclosure, you would have to get permission from the owner or a court order. You can imagine that would be a fairly difficult thing to accomplish, particularly in cases where you needed to do something very quickly. There were a number of stories that were told by legislators about the property preservation companies coming in and changing the locks and, stealing things from someone's property, et cetera. Horror stories, many of which, I think there was probably another side to the story. Nevertheless, we were ultimately able to get a very strong letter from FHFA that basically said if the Connecticut legislature were to do something like this, we would have to change all of the mortgage documents in Connecticut to include a waiver that would account for this provision. And when the legislators heard that, they said, "Okay, we surrender," and the bill did not pass. And I'm hoping that we won't have to remind them of that again, but we may. The next bill. Go ahead, Norm.
Yeah, that's such an important point. Again, we're talking about the Fannie and Freddie being great sources of liquidity. I forget the exact percentage, but it's over 70% of the loans funded in Connecticut are Fannie Freddie loans. But also on 5090, which you just mentioned, that mortgage forbearance and crumbling concrete foundations loan also would have required a change to the Connecticut form of mortgage. So, this is one of those things the legislators aren't thinking about that, although they should be thinking about that. So we just have to be wary and keep reminding them. And, that was an amazing job to get that. The home invasion bill was pretty scary this year. And that was, I think, a lot of work and effort went in on the part of the legislative committee. And that was very important that we were able to get that knocked out. So
yeah, thanks, Norman. You're right. 5090 would have required amendments to the mortgage documents as well. And it, thankfully, we still have a number of folks in the legislature who practice either real estate law or otherwise that understand those things. But it's difficult to get that through to the majority of folks sometimes. But thanks for that input. 6441. This is becoming a perennial favorite, and it basically would have given all 169 towns and cities in Connecticut the ability to, by their own legislative option, to require a conveyance fee on the sale of certain properties. And they had a sliding scale that was applied to what some folks called a mansion, which really started at about $350,000. Not a mansion in my book, but nevertheless, and the money to be raised would be used for open space purposes, clean air, that kind of stuff. And it's something that we have seen a lot of in the past. We were able to really convince the governor's office, who was one of the prime pushers of this proposal initially, to back away from it. And really what and allowed us to do that was the nature of the way they had drafted the bill, which said that each town could do it on their own whenever they wanted, which really would have created a nightmare for folks who were trying to comply with all the TRID rules to have a closing. And so we'll see where it goes. Hopefully, if they propose it again, they'll do it the same way, as flawed as it was, but we shall see. We see that a lot. Next page, Denise. I'm not going to go through all of these bills on the next two pages. I would encourage you to take a look at these. These are bills that, for the most part, didn't make it very far in the process, but they do give you an indication of the kinds of things that that legislators are hearing about from their constituents A lot of them are one-off complaints, I'm assuming, and some of them are not. Some of them I see, on a regular session basis. I think it's instructive just to see what folks are considering. The one bill that I would call out in these lists is 6369. And this deals with a lot of things, but I think the biggest item in this piece of legislation would have been for folks to be able to accept payment other than a wired form from the lender. So a check, maybe a check from the attorney's account, et cetera. And there was a lot of debate between the lenders and, frankly, the title companies about whether or not this is a good idea. Some folks said that we need it to be on a wire because that's the most secure, and others said the exact opposite, which was wire has become so unreliable in terms of fraud that we would rather go to a check system. So this is going to be back, and folks have an opinion about this. It'd be good to share it with us so we can get a sense as to what the real case is on the ground. So Denise, you could flip to the 2021 legislation of general interest, please. This first piece of legislation does a lot of stuff, but Senate Bill 986, among other things, allows for companies, corporate companies, et cetera, to have their official meetings held virtually. Another, I would think, positive result of COVID. Next page, please. Call centers. I'm not sure if folks are on the line who have call centers or are thinking of bringing one to Connecticut, but if you are or will, you'll be interested in this. Originally, this bill was a lot worse than it ultimately was, but it's still not that great. It basically says you have to disclose to the Department of Labor if you're going to move your call center. And if you fail to do so, you're going to be fined $10,000 a day for that action. So the disincentive, I would say, for folks who want to establish call centers in Connecticut, but it passed. This next bill, and actually the next four bills are bills that I referenced earlier in my remarks about really probably wanting to get some of these things to your operations people or your HR folks, just so that they have this on their radar screen. You'll see that they did make some changes that folks might be interested in. This first bill did a lot, very controversial bill. I think they had a 10-hour debate in the House on it. Senate Bill 1019. What this bill does is it erases certain misdemeanor offenses and felonies after certain time periods of time. So your record, if you had done something that was a misdemeanor, for example, after a 7-year period without any further convictions, your record would be completely erased. So as an employer, you would not have the ability to see that or even ask about it. Next page. Sorry for the small print on this. This bill did a lot, but again, I encourage folks to pass this along to the right folks in your organization. But a data privacy breach piece of legislation. This is law that covers a situation where your company maybe lost social security numbers or other private pieces of information about your customers, and how you have to report that to the Attorney General, et cetera. The industry viewed this piece of legislation as really just a modernization of what is a pretty good law. I think Connecticut has a really, when you compare it around the country, pretty good law with regard to how companies have to operate in this space. But it does make some real changes, and you should share it with folks who would be in charge of this issue. Next page. Denise, you want to just go to the next page, please? There you go. Thank you. Again, small print, a lot of stuff here. This bill, and I couldn't begin to explain to you exactly what it does. It deals with unemployment compensation. It was hailed as a very, very good piece of legislation for all different folks who are interested in this topic, including businesses. The Connecticut Business and Industry Association, CBIA, was actively involved. The governor's office was, the unions were involved, and the Labor Department. And it made some really good, significant changes to our unemployment comp situation. As some of you may recall, back in 2008, the state of Connecticut, along with almost every other state, wound up having to borrow money from the federal government to keep their funds solvent. We had just recently gotten those loans paid off, and then COVID came, and we had another obviously major problem with unemployment compensation. And this bill attempts to address that, and also does some things that go back and fix some things that historically had been problematic for the business community. So again, I would share that with your folks who deal in that space. The next two, just real quickly, because I'm sure everybody's aware, and don't have to spend any time on it other than to say you can now sit on your couch and bet on the Giants game while you're getting stoned smoking marijuana. So it's I don't know. Sounds like a good Saturday afternoon to me, but. The next few pages are about the budget. You want to go to that, Denise? Thank you. We had Connecticut had a stellar year in terms of its budget. Surprisingly, I think people didn't expect it, but when you think about it, the pandemic really it impacted people most severely who were making less money and probably not contributing a lot to retirement funds, et cetera, versus 2008 when that impacted folks of all sizes and shapes, but high earners as well. But the stock market did really, really well, and a lot of those gains are reflected in the state's budget this year. In fact, there was so much money that was coming into the state. We have a thing called the volatility cap, which was put into place about 5 years ago or so, that said after you reach a certain amount of surplus dollars that are coming into the state's coffers, all those surplus dollars have to go into the rainy day fund. But at some point, that fund gets capped, and everything over that goes to pay unfunded pension liability for state employees. And there was a very large chunk of money that went toward that unfunded liability as a result of the revenues exceeding that cap. So that really good news for everybody, in my opinion. Next page, Denise. This page just, I think it's interesting because it just shows you where the money comes from in Connecticut. Not much more to say about it, but I think it's just good to see that. And if we want to go to the next page. So taxes, there were a lot of bills that were considered with respect to taxes, and this is a little bit like some of the bills I described that it's instructive to see this, even though some of these things didn't pass, because you know where folks are going to be coming from going forward. But the two items at the top, the business tax surcharge, that's the 10% corporation business tax. It's been sunsetted forever, kind of like the foreclosure mediation program, but they finally made that permanent. And the other tax really impacts trucks. It's called the highway use tax. The governor has been unable to pass tolls, and politically he was probably smart enough to not bring that up this year. But the Transportation Infrastructure Fund is very quickly becoming broke. As everybody knows, we have a serious transportation infrastructure problem in terms of its aging. It needs to be fixed, and the governor is trying to do what he can in this space. And hopefully the feds will pass an infrastructure bill that will send some dollars to Connecticut to address the problem as well. But that did pass. The consumption tax, which failed, some called it the mansion tax. This would have, no, this wasn't the mansion tax. This just would have gone after folks who make more than $500,000 a year. That did fail, but it does show you how some folks are thinking, and the wealthy need to pay more. Digital advertising tax. I think of everything on this list, this would be one that almost anybody who's in any kind of business in Connecticut would be against. It would tax digital advertising, and it was done under the guise that it would really only impact the Amazons of the world, when in fact places like France where this was implemented, the big online advertisers pass all of these costs on down to all their customers, no matter how small they are. So it was a bill that was had a lot of momentum for a while, but we were ultimately able to defeat it. Capital gains tax was out there. The governor was way out in front on not supporting this, and mostly due to that, I think that's why it didn't pass. And lastly is the mansion tax, which $430,000. I think I misstated earlier. It was $430,000 or more would be considered a mansion. Next page, please. Closing. So 2022, we don't go in session until February. It's a short session. Will be done in May. It's the second year of the state's biennial state budget. So instead of a whole new budget, they'll do modifications to the budget. Whether or not we're virtual or live really remains to be seen. I think the goal is to be an in-person legislative session, but depending on how things look as we get into the winter with COVID, we shall see. It will be, I think, a very interesting session. One of the things that if they do go to a live session, we counted it up. There were 25 legislators this past session that have never been in the building, the state capitol, with the public or lobbyists there. So they've never seen a lobbyist in the building. They've never been tortured by us, as they try to go to the bathroom. And it will be very interesting to see how shocked they're going to be when they allow the public and the lobbyists back in the building. So with that, I'll close. And Norm, I guess we can wait till the end for questions, or I can take some now.
Yeah, I think maybe we can hold off, as I know that Rich and Tracy have a lot of comments. Thank you, Fritz. That's great. I think you and the legislators are going to need some sort of sensitivity training before you go back in person, how to deal with folks actually in person. But thanks. That's a great report. I think you covered all the bases. I really appreciate that. Our next panelist, I think, Rich, you're going up next. And
Yes.
As usual, we're eagerly anticipating your thoughts and comments on the DOB perspective. I know you don't hold back, so this is a rare but regular treat for our folks. So why don't with that, why don't you go ahead, because I know you've got a fair amount of time, a fair amount to say, and we're more than halfway through our program.
Okay, I'm going to try to share my screen here. Let's see how this works out. What are you seeing?
We're
Looks
seeing
good.
the DOB perspective.
Oh, excellent. Okay. So let me get this going over here. Okay. So temporary authority. So our MLOs have had temporary authority now for about 2 years. This actually, we talked about it the last time we were able to meet. And now with 2 years experience in it, I'm just going to go over a little bit about it and what's happened. So those who aren't licensed in Connecticut, working for a company that's licensed in Connecticut, have to have been working for a company that was licensed for 30 days prior to application. So the MLO has to be working for a company, and then that company has to be sponsored, has to get a license in Connecticut if they don't already have it, but they have to have continuous employment for 30 days prior to the application. And then they eventually need to be sponsored by a state licensed entity. That's just to get the application in. So hopefully the company's already here, they just work in another state and they want to add the state. That's what they need to do. For MLOs who are registered with a bank, they would have had to have been with the bank for the 12 prior months before applying. And then they have to be licensed by a state licensed, sponsored by a state licensed entity. Excuse me, I'm trying to go a little bit too quickly here. So those were the requirements that were originally passed, and they've been working out just fine. So in order to be able to apply, an MLO must not have had any issues that would disqualify them from licensing to begin with. So, you know, they can't have any felonies in their background that are related. They can't have any unrelated felonies in the last 7 years. One of the items that Fritz was talking about that totally freaked us out was that, you know, some of the criminal background was going to be unavailable when we're looking at these people, because a substantial number of misdemeanors that are financially related could knock you out of contention for the ability to get a license. So as I read it, it ended up, it wasn't that bad for us. We would still be able to do our work. But that one proposal that passed totally freaked us out for a while. So anyway, they have to submit a complete application to us, and they have 120 days to complete the education requirements. That was the big deal. That's what was always holding back the MLO. So that's been working out fairly well. So it's been in place for about 2 years. 85% or more of all the applications come in through the TA process now, the temporary authority process. Most MLOs get it done the way they're supposed to within 120 days. And we've denied a real small number of individuals who in the end didn't qualify, had misdemeanor issues that they couldn't get past, never signed up for the training, that kind of thing. But it's a small handful of those. So then moving on from TA, the commissioner issued an order on July 1st of 21 permitting remote office locations. So this stems from the fact that during COVID, we took a no action position on going after people who were teleworking, so to speak, right? So the MLO is not in a licensed location, they're working from home. We could go after it. We took a no action position because it made sense due to the pandemic, right? So this makes that a little more permanent, and it provides that companies have to complete certain requirements in order to do this to our satisfaction. So when we go do an exam, we're gonna make sure the company's got a list of the MLOs that are working from home, why they're working from home, the fact that they couldn't be in any other licensed location in that meantime. And as long as they get through all of those requirements and have it documented, we're good with it. So that's our way of making permanent the changes that MLOs can work from their home or whatever other location they need to work from. That's not their licensed office.
Hey, Rich, do you have any idea, I mean, in terms of the numbers of MLOs who are working from home versus working in office now?
The best guess I can give you is that it's a lot of them.
Okay.
And as a matter of fact, you know, we had a 100-mile range for MLOs from their residence to their licensed branch. So that kind of went by the wayside with this because the MLO can be sitting in Ohio and the company is a California company with no branches in Ohio, right? And the Connecticut license branch is the main branch in California. They'd still be allowed to operate from their homes. So I'm suspecting the number is fairly high. We haven't done any examinations on this yet. We're kind of homebound still right now. We can't go out. But and this just came in July, so I'm not expecting everybody to par with the requirements yet. So probably next year at some point, we'll do some more exams and include this as one of our regular things. But right now, we can't really tell.
That's something for our folks to be aware of and, you know, be prepared to respond to any inquiries.
Yeah,
concerning this.
read the memo. If you need a copy of it, I can get it to you. There is a point about 5 to 7 points that you need to comply with in order to make it happen legally, but I don't think they're a giant leap to get over those.
No, and it is on our website as well.
Yeah, that's the July 1st order.
Yes.
Okay.
Okay. So MLO apps have continued at higher than normal paces. Normally, we have the renewal period, then we'll get some applications, and then there's kind of a lull in the summer. We've had no lulls. These guys have just been coming in out of the woodwork. So my guys have been constantly busy processing applications. 2020 stats for Connecticut, LOs went from 8.5 to 10.1 in Connecticut. Similar to what we expect to see for this year. So we'll have another 2,000 to 3,000 increase in MLOs in Connecticut. Home purchases grew 53%. However, refis grew by 295% from the prior year in 2020. So that's reflects the low rate environment, but that's why you're seeing so many MLOs getting into the business, is that there are a lot of opportunities in there to make loans. So nationally, the MLOs increased by 21% to 688,000. That's pretty big. And these kind of increases are where you begin to see fraud starting up in the system, right? Everybody and their uncle wants in, and they're going to do whatever they got to do, whether it's legal or not. So
They're so suspicious.
yeah, 32 years in this has kind of jaded me over a little bit.
Okay.
So yeah, and we have seen a little bit of that. These things do tend to go in patterns. We saw it at the 2008 failure. We saw a lot of that fraud happening there. And we've seen it at various points along the way. As things get heated, these guys come back. Okay. So enforcement and licensing issues, MLOs cheating on education requirements. We've had 2 really big cases that I can't go into too much, but MLOs and education providers have figured out ways to cheat on what the requirements are, and to show somebody has been at a program that they've never been at, or taking classes that they've never taken. The NMLS is very good at being able to track who is where during these classes. They have a real crack staff looking at computer data, and they find these things out. So there's at least 2 major investigations right now, and it's probably a third coming down the pike at education companies and MLOs acting in concert to supervent the education requirements. Another thing that we found in our mortgage company applications is that we've seen MLOs with extraordinarily high loan counts, right? Think about what an MLO has to do. They have to go out, well, they have to drum up business, right? They have to meet with the person in whatever way they meet with them. They have to get the information, they've got to put it together, they've got to get it onto an app properly. It's got to get to the consumer has to agree the app is ready, and then they go, right? Well, imagine being able to create enough loans to have 3 to 4 closings every day in the quarter, right? 90 days straight, 3 loans per day, that's 270 loans. Do you think one guy could do that? It's just absolutely impossible. So there are, as we're looking at business plans, we're finding that unlicensed individuals are doing part of the process of taking the application. And it comes under the guise that, oh, well, my guys don't talk about rates and they don't talk about fees, but they do everything else. And then they give it to an MLO. So if that sounds familiar, it should. We had a major case about a year or 2 ago that dealt with that sort of issue. And we're finding that in a lot of business plans. And the way we get to it is by actually looking at what the rate of closings is for each MLO.
Rich, this is an important point because I've had actually a couple of clients who've caused me to have discussions with the Department of Banking over the years, because the department felt that certain employees were engaging in unlicensed activities. So this is something Connecticut feels particularly strong about. There's a fact that increasing technology capabilities could support higher volume per MLO or
So, right, I get that. And I have been considering that as I look at these. So there are some companies that operate strictly through a call center methodology, right? And all of their individuals are licensed when they talk to a consumer. There may be some individuals at the very front of the house that will ask the consumer what state they're from, and then they'll route that call to a properly licensed MLO. And that's all that unlicensed person does. So if that's the case, when I look into what the company is doing, then yeah, okay, maybe that guy's just getting a lot of calls, whatever. But if it's not a case of we have a call center operating properly and legally, or we've got, some of the major companies that get their apps through the internet, through special apps, maybe without naming any names, that might make sense too. And we do look at that specifically to make sure that there's not some other intervening factor going on. And we asked the company, how are you originating this many loans per MLO? Explain to us how this happens. So we give the companies a chance to tell us, how is it that it's working? So we're not just going blind on data that we see. We definitely have a conversation with the company.
Okay, thank you.
You're welcome. The rest of the enforcement licensing issues are basically your standard variety advanced change notice and unlicensed activity violations. You have an MLO who might originate a loan before after they've made an application, but before they've actually gotten an approval. That kind of thing happens on and off. And we have a sharing agreement with the CFPB and all the other states. You had asked me to talk about this a little bit. So that sharing agreement has been in place with all the other states through the MMC for years now. I want to say probably close to 10 years now. So we're cooperating with other states all the time. If we start an investigation, we will have a phone call and see if anybody else has noticed that activity in their state with that company or not. So that's been going on since we made changes back in 2008. And even before then, we had we didn't have formal sharing agreements, but we did have conversations. The CFPB, on the other hand, is a little bit more recent, but we have signed sharing agreements with them. If they come across issues with a company that's headquartered in Connecticut, they will talk to us about it. And likewise, we will talk to them about it if we think it rises to a federal level. So there's no barrier for us to talk to each other. We do currently participate in multi-state and coordinated actions. So the multi-state exams, those are with other states. And the coordinated exams are the ones with the CFPB. They can't do a joint exam or an exam where we all participate in. So what we do is we coordinate our actions with the CFPB. So if CFPB goes into mortgage company A, it just so happens the CFPB has no authority to look at financials at all. All they can look at is compliance. So we will split the activities with them, help them on some of theirs if they need some more manpower there or people power. And then we will look at the other things that they statutorily can't look at. And then we will produce together separate reports that mirror each other in the results more or less, but are coordinated so that we are both on the same page at the end of the jobs. And we present them that way to the management of the companies. Did I hit all the points you wanted, Norm?
Yeah, I mean, this is very valuable because again, I scan the weekly DOB bulletin and seen very little in terms of published enforcement actions against the mortgage community, and we just want to make sure that the CMBA members are aware of potential areas that could lead to concerns, and so this is very helpful. Thank you.
Yeah, so if we do have actions against the company that we have done a coordinated job on, it is, depending on what it is, the action may be together with the CFPB, which is probably the most effective and efficient, or it may be the CFPB's group wants to do theirs separate from ours, and that's fine. So you might see them separate, you might see them together. Like I said, the most effective way is together. So, okay.
Great.
Examination updates. So our regular exams are having minimal issues these days, just the usual things. One-offs, maybe of advertising issue is kind of common, but it's not a big deal. We've begun doing entrance exams. I don't know if anybody's aware of that. So if you're newly licensed with us, we try to get to you within 1 year to make sure you've got the proper policies and procedures in place, that you have good loan origination practices in place, and then generally make sure that you're getting off on the right foot. There's some companies you don't get to right away. They don't seem to be a problem, but then you get in there a couple of years after they've been licensed and you realize you should have been there earlier. So, and as part of accreditation from CSBS, this is one of the things that they wanted to see as well. So we thought it was a good idea, and we began doing this about a year ago.
I was actually not aware of that. And I've had clients over the years say, well, they never came in, we've been in business X number of years, they never came in. And all of a sudden we thought we were doing business great. We've, filed our reports and, weren't aware of any issues. So this sounds like it's actually a very fine idea. And, because frankly, all of these people operate by virtue of a license from the commissioner who says, basically, these are good people. They have the integrity, and are okay to do business with. So, if there are problems, it's best to, sort of get people off on the right track, off on the right foot, as you say.
Yeah, I think this is a phenomenal idea. I think it's a long time in coming. The one issue that we have, as many other states do, is staffing levels. we just can't get to everybody in a timely fashion at this point with the people that we have working on the issues. So we try to get to everybody within a year of licensing. It might go a little bit long, it might not, it depends. Because if we have a major exam with a major enforcement action, we might have all of our people working on that because it's so important. So it might delay some other things. So, you know, maybe as staffing increases, we'll be a little bit more efficient at this, but we figure catching people early is the best way. Okay, MCR updates. This will be quick. So version 6 that we came up with in 2018 now, I think it was, still waits for implementation because NMLS 2.0 hit a hard stop and they've been reworking it. So as soon as the next version of the NMLS is in place, they'll begin coding the version 6 of the MCR to be used at that point. We do have a request in for some new data fields, which I'm actually presenting to the NMLS Policy Committee later on today. And what it has to do with are the lessons that we learned from COVID. It turns out that we don't have enough servicing data to know what's going to happen to the servicers on a national basis when major events happen like COVID. And COVID is just one example. You know, it could be the entire Western seaboard is on fire permanently because that's what happens there, right? So what happens to mortgagers whose houses have burned down, who, you know, they're displaced, their businesses are closed, they can't go to work, right? That's an emergency, isn't it? The Midwest, you may experience excessive flooding, which we've seen lately from Texas on up. Those companies get wiped out the same way in a different way, and the consumers get wiped out as well. So as we noted, what was happening during COVID, and we looked at the MCR, we realized we had to make a direct call to about 20 servicers and ask them to report certain data to us directly at the MMC. And, you know, that was fine for now, but that's not really the way to go. I don't like to deal with issues only when I see the fire. So what we did was we structured a group of data that would be necessary to have during one of these emergency type things. And we're incorporating it into the MCR.
What kind of data do you, can
So-
it be?
I can't yet because I haven't presented it to NMLS yet. I won't have approval for it. But I will be the first to know once it's approved, ready to go.
Oh, okay.
But it's, you know, it has to do with past due. It has to do with how many of your loans are going into a forbearance because of whatever the emergency is. It has to do with your liquidity levels. What are you required to pay into? So I don't know if everybody knows how servicing works. Sometimes, regardless of whether you collect all the payments from the consumers or not, the servicer is required to make the full payment into the GSE or to the loan pool, whatever it is. So imagine that you've got zero income coming in from the loans, but you got to make the full payment to the pool. And now on top of that, you've got more loans because of whatever the emergency is are going past due. So now you have to increase collections services on those, but you're not getting paid. On top of that, while you're not getting paid, you still have to make sure that all of the taxes get paid and that insurance is covered on all of those properties. So there's a huge amount of cash outlay that occurs on the servicing side that, you know, we don't normally think of. That can lead into a cash crisis, liquidity crisis, and suddenly the company goes down because they just don't have the resources to keep up. So that's what we were trying to watch during the whole COVID experience. And that's the kind of data we're going to be collecting.
Are you looking for that data so you can afford any sort of regulatory relief or reprieve? or so you can take regulatory action.
Well, I mean, it all depends on which side of the fence you're on, right? Our goal is to keep the company from failing by taking advance action and making sure that consumers don't get hurt in the process either. It's more of monitoring the health of the servicers at the time that there's an event and trying to get in there before things get critical because people start making stupid decisions in the meantime.
Okay, great.
Okay, student loan services. Servicer license, excuse me. So we've had a statute since 2016. We got preempted by the feds. The Trump administration had said, you can't do anything. Those are federal loans, can't touch them, can't look at them. So we moved forward with the licensing of non-federal student loan servicers, and we've been doing exams on those ever since. Administrations have changed. Richard Cordray is now in charge of FSA. I'm sure you all know who that is. He's the guy that was first in charge at CFPB. He is very consumer oriented. The FSA now is allowing states to register the federal student loan servicers. So we can't license them, but we're allowed to register them. And we're working out some kind of oversight regime with the FSA now. And that's as far as we've gotten. We don't have anything definitive yet.
Do you see any crossover to the mortgage servicer or the mortgage licensees at all, or just there'll be another category of licensee that I understand Tracy is going to be responsible for?
Yeah.
Not licensee, but registrant. Yes.
Registrant, right. No, this will be just another license or registration that we have on our long list of registrations, but I'll let Tracy, excuse me.
Okay, well, at this point, Rich, if you're through, we're getting, well, we still have some time, but I guess I would like to introduce Tracy. Tracy may be a new face for many of you. She has come on board with the Connecticut Department over the last year or two, and she is a manager at the Connecticut Department of Banking's Consumer Credit Division. And one of her interesting background experiences is she owned a mortgage company. So that's, I think, is going to have oversight for the mortgage area. So Tracy, maybe you could tell us a little bit about your back. Oh, go ahead, Rich.
Before Tracy gets into it, the worst part about her job is that she has to keep me corralled. She's a strong woman.
Okay, so she has to be.
First, I have to get him to call me my right name, though.
Okay.
He's gonna pay for that later, just so you don't know.
I am, I'm
Okay.
sorry.
I'm only teasing. But thank you for having me. Yes. So my name is Tracy Kelly, and I've been with the state now for a couple of years. I think it's going on my third year. You can say I started a second career. My first 30 years was in the private sector. I spent about 10 years as the district manager of a mortgage company in New York. And then I decided to open my own mortgage broker firm about 20 years ago and did that for the duration, which was quite interesting. I learned a lot of hard lessons, a lot of great lessons. And I decided now to jump over onto the other side of the fence and be in regulation. So it's been fantastic. I must say I am in a unique position because I do understand what you folks go through on a daily basis, understanding operational needs. And I try to articulate that every chance I get, probably ad nauseum, Rich would say. But I will say that my expertise and my insight has been welcomed at the Department of Banking. So it's been fantastic. Now I do oversee some mortgage area. Of course, Rich has got it, like it runs like a machine. I also oversee the student loan area. But in the Department of Banking, particularly the consumer credit area, we oversee 11 license types. So mortgage in its own right is huge. Student loan is a hot button right now. So is money services business. And then we also have consumer finance and debt. So we are very busy at the Consumer Credit Division. And just to give you a little bit, I know Rich mentioned federal student aid. We're looking forward to hopefully working with them. But just to give you a little bit of maybe just some stats that I wrote down earlier, the CFPB has logged 7,000 student loan servicing complaints between half of 19 and half of 20. And that was really during the moratorium. So the moratorium of suspended payments ends at the end of January 31st. There's 1.6 trillion in federal student loan balances right now, and that accounts for 45 million borrowers. One of the sobering facts that I found this morning was that the student loan debt totals 124 billion, which is defaulted. So over 1 million student loans enter default each year. So right now there's a whole lot of emphasis on student loan servicers and their accuracy and their commitment to customer service. I don't know if any of you have student loans or your children have student loans, but it is quite a mess, and it's a lot to learn as you try to navigate through repayments and everything. So again, I've been lucky to have this second career opportunity. I've landed in a fantastic area who is welcoming, who puts up with me, right, Rich? We go at it a few times, so it's all good. But again, thank you for having me, and I'm happy to answer any questions.
Well, thank you, Tracy. I mean, I've been working with the Department of Banking for decades, and always, I believe, to have a very constructive and cooperative relationship with the Department of Banking, as has obviously the CMBA and our lobbyists, Fritz and Gaffney Bennett. And we look forward to you as another point of contact, and certainly will try to take advantage of your background in the mortgage area. When I first saw the slide on the student loan servicing, it occurred to me too that one of the obstacles or impediments to family formation and home ownership is student loan debt. So hopefully you can make all of that, rationalize that mess, or be part of help.
Right. As an owner, I was also an operating mortgage loan originator. So I know the obstacles that we faced, with the student loan payments and trying to get these folks in their first home. It's a daunting task. So I naturally fell into student loans servicing area, and it seems to be a really good fit. And the more and more I get involved, the more and more I realize that the two industries are incredibly similar with regard to the servicing aspect.
Yeah, my final question for you both is, and of course this is an unfair question to pose to either of you, is when is the Department of Banking going to change its name to the Department of Financial Services?
Who knows? I haven't heard that one yet.
No, it's good because originally when I first started dealing with the Department of Banking, it was banks that were clearly the primary focus, but in light of the consolidation and the emergence of these other license categories, the focus of the department has changed. So at this point, it's it's 10:26 according to my my computer screen, and I know that we've had a number of folks who've been listening. If anybody has any questions for any of the panelists, this would be a good time to raise those questions, or we can return, give you back 4 minutes of your day, if not. And Jim.
Yeah, I have a question. Persons who are doing a shared appreciation agreements, do you have many new license applicants or people applying for that license?
So I think we have one company that is exploring it with us at this point. We don't have any. We had some applicants a couple years ago, but because it wasn't well defined and it was hard to determine, is this really a loan? Is this not a loan? Is it a mortgage loan? We couldn't do anything with it. But at this point, it's been defined as a mortgage loan. So at this point, we can begin that licensing process.
Jim, great question, because I actually had meant to add that to Fritz's presentation, that the licensing of folks who engage in shared appreciation, mortgage transactions are now also subject to licensure in Connecticut. And perhaps only in
Thank-
Connecticut?
I don't know.
Yeah.
I think that may exist in a couple other states at
Okay,
this point, but it is gaining traction everywhere.
okay,
At least define it and put it into a category that's licensable.
okay.
Thank you.
Thanks, Jim. Any other questions? If not, I would like to thank our panelists and thank Denise for hosting this. Once the legislative session, we get closer to the legislative session, I know that Fritz and Denise and I will be and Larry Garfinkel and James Moran, who chairs of the legislative committee, will be in touch with our members to start up our legislative committee calls once again. That's, I think, been rather successful over the past year. But again, thank you, everybody, for your attention and time, and we'll look forward to seeing you at our next legislative update, and hopefully before then. Thank you, everyone. Have a great day.
Thank you.
Thanks.